All right, today is March 25th, 2023. Yesterday I didn't make a video because I had a lot of thought that I wanted to think about and put into in the market. And I've decided that I believe that we're entering the second phase of what I call a bear market. I know a video a while back, I talked about in the 70s where we had a first downturn, market came back, then we had a second downturn that took away the lows and went significantly lower. I believe that we're in the beginning of that phase. And it has me, I would say, I'm a little worried, and I'm going to go through the reasons why I'm worried. But as you know, as a long-term investor, a downturn creates an opportunity, and we hope to take advantage of that. And I have some points here that I wanted to emphasize, and the reason why I think that. First, let's talk about the big banks. And let's talk about the reason of why we're in the crisis that we're in. So back during the beginning of the pandemic, we know that the government gave away a whole lot of free money, and that free money was spent a lot on goods and services, mainly goods, now services, and then a lot of it was deposited in the banks. The banks was at their highest level of deposits, probably ever. And so when banks receive deposits, they have to do something with that capital. They either have to deposit it. They either have to loan that money out in car loans, housing, which they did a lot of that, or they have to invest that in some type of long-term safe investment, such as bonds or mortgage or something like that. So with the banks, they did loans on housing, they did loans on cars, but they did a lot of long-term investments. So the Fed, not only did the government give away a lot of free money, the Fed lowered interest rates to zero, which meant that when the banks was buying these long-term bonds, these bonds were close to zero interest rates. So now that you rise up now that you start raising interest rates, as I talked about in last videos, the price of bonds started going down for bonds that was purchased in the past. So now that the banks have all these low interest rate bonds on their books now with lower prices, a couple things that affect. One, they have bad loans on their books, but because they're not allowed, they don't have to market it. They don't have to take the losses in the short term. They could carry those loans. But the bad part about that is they can't really buy other banks, because if they buy other banks, then they have to market their books, and they have to market the bank's books that they buy. That's why we're not seeing any purchases of like regional bank to regional bank to try to save the crisis, which that's a major problem. And then big banks aren't allowed to buy little banks based from 2008 and 2009. So we're removing big banks from the crisis. From buying other banks, and we're removing we're removing big banks from buying regional banks, and we're removing regional banks from buying other regional banks, even if that regional bank is strong, because they have to market their long-term bonds. I hope I was able to explain that in a way, if you didn't understand, that you can understand it. And then we have the politicians. No politicians, we're having a hard time coming up with rules to save the banking system, because 2008, 2009, after that crisis, it was such a sour mouth in American society that we was bailing out big banks and we wasn't helping Main Street, that a lot of politicians don't want to get behind that. So what that tells me is, now we're going to save the system because that's what we do. But we're going to have a crisis before anyone is really able to get behind a major program that would save the system. Okay, let's talk about Duetsche Bank. On Friday, Duetsche Bank, their credit default swaps started going up. And what that means is it costs more money for a bondholder to insure their bonds in case Deutsche Bank goes under. Now we know that UBS just bought Credit Suisse with the support of the Swiss government, and they basically made them buy it. I don't believe the German government has a bank that could come in and buy Deutsche Bank if need be. And we're certainly not going to see a big American institution purchase Deutsche Bank. So I don't know who's going to save it. The only person who can save that is the German government. Also on Friday, the Federal Reserve announced after the market closed that $100 billion of deposits was withdrawing from the system. So with all that being said, I believe, and the reason why I'm worried, I believe that we're going to have some type of major banking crisis. We already done had 3 banks fail. When 2 banks fail, First Republic is in really big trouble to fail. The big banks came in and gave them $30 billion in deposits because no one can buy First Republic, which is the reason why they did that. So I believe we're going to have a banking crisis. And I've been doing this now for 25 years. And whenever we have a major downturn, there's always panic. We haven't had panic. This has been a nice slow grind down, since October. October is when we hit the low, so it was probably like maybe we bounced back up from October to January, and we've been kind of going back down since. But we haven't had fear. We haven't had panic amongst investors. So I believe the things that I laid out today, based on the banks, it might not happen next week. Now they're meeting this weekend. I'm pretty assure you that. So I don't know if we're going to have an announcement on Monday, but there really hasn't been a panic. And I believe that we're going to have a panic, and that's going to bring the stock market down as a whole, I believe. So we have to be prepared to take opportunity. I looked at my portfolio, and I believe I have 10% of my investments are in banks, and I'm willing to take a short-term loss because I'm not going to sell to have a long-term opportunity to buy really, really good companies at really, really good prices. And I would recommend that you take advantage of that opportunity also.